Today, our plans ahead and what happened in 2022. Hello again, it's Martin North from Digital Finance Analytics, one latest posts covering finance and property news with a distinctively Australian flavour. Well, it's the start of the new year, and so as normal, I'm just going to look over the last year and specifically at our most successful posts in terms of the numbers of viewers, and also talk a little bit about what we're planning to do in this year. So currently we've got around 63,292 subscribers, up 5.5 thousand through the year. So thanks if you're one of those who subscribed during 2022. And there were about 3.9 million views on the channel last year, about the same as the previous year, which, given the proliferation of channels, is not too shabby. And the overall watch time was up 6% to 745.5 thousand hours. Now, looking at our most successful posts, the 12th most watched was one called New Zealand Credit Falls Off a Cliff. Home prices will follow. That was from April the 25th, 2022. And of course, that discussed what was going on in New Zealand. And in that show, we looked at how credit tightening was running in New Zealand and how that will impact home prices. We're of course seeing that in spades now in New Zealand. And I argued then that in New Zealand, properties will fall further and faster. And so it proved to be. The 11th most popular post was another one from New Zealand called New Zealand's Emerging Property Disaster. That was from June the 3rd, 2022. And there we looked at the latest data from New Zealand and how the property portals spin the story of rising stock on the market, falling prices and confidence against rising mortgage rates. And again, we discussed how we can probably extrapolate what may be going on here in Australia in the months ahead, considering that our rates were at that stage and still are behind the New Zealand official cash rates, which of course have continued to rise higher and higher through the year. In 10th place, the show called the Dominoes, They Are a Fall-In with Tarek Brooker from the 8th of July, covered the latest events in the market with journalist Tarek Brooker, who regularly appears on the channel. And there we discover the latest economic and financial news courtesy of his famous slides. Now in 9th place was the show called No Escape, Recession Will Destroy Wealth, period. That was from July the 2nd, 2022. And there we reviewed the week's market action, starting in the US, and then went across to the other areas from Europe, Asia, and Australia. And we argue that there was no place to hide. Wealth is being destroyed, and there's no end in sight. Data is flagging a recession as central banks continue to raise rates. And given the astronomical debt burden out there, this is a big deal. And in fact, even then, conservative investment strategies are being hit. This is a train wreck, said Alex Dunnan, Executive Director of research house Rainmaker Group at the time. When a traditionally conservative strategy is getting the worst returns, then all bets are off. It doesn't matter where you go, almost everything will be in pain. And of course, at that point, the S&P 500 notched its worst start since the 1970s, plunging 20.6% between January and June, and the Dow had its largest first half drop since 1962, and the Nasdaq Composite had its largest percentage decline ever. And US stocks slipped over those 5 days I looked at, with the S&P 500 erasing part of its rally of the previous week, down more than 2%. The index just endured the 11th drop in 13 weeks at that point. And of course, all three indices continue to post loss through the week and through the year. And as we reviewed in our post yesterday, of course, it ended up as a very, very bad year indeed. Question now is, of course, whether 2023 will be any better. And it's worth underscoring again that the tech-heavy Nasdaq underperformed the most. But treasuries also surged, and that, of course, meant that bonds went the same way as well. So Wherever you look at it, the economic data was pretty horrid then and remains pretty much so. Softer consumer spending, sagging sentiment, and subdued manufacturing suggests that the US economy is in fact more fragile, prompting several forecasters to lower their estimates for growth and, very importantly, for earnings. And strategists at the time from Goldman Sachs said stocks could keep falling later this year since equities are pricing only a mild recession and more companies will likely begin reducing their earnings expectations. And at that time, in the event of a recession, Goldman's team saw the S&P 500 dropping to around 3,600. Now, in eighth position was the show A Dire Warning for Mortgage Holders from March the 25th, 2022. And that was talking about another major bank coming out with a belated warning for mortgage holders as the impact of higher mortgage rates begins to hit. And meanwhile, Westpac reaffirmed their rising expectations and continues to lift fixed rate loans to boot. And of course, we've continued to see that through this year. In seventh position was a show called Shh, You Can Hear House Prices Falling. That was with Tarek Brooker on July the 22nd, 2022. And in that latest chat, once again, we explored home price dynamics, politics, and much more besides, using his wonderful charts. In sixth position was The Next Crisis Has Arrived with Tarek Brooker again on April the 15th, 2022. And there we parsed the latest data and concluded that the next crisis had actually already started. And we also questioned the quality of the current political dialogue, the role of central banks, the relationship between interest rates and inflation, and much, much more. And we had to make do with just 15 out of potentially 50 plus slides that Tarek had at his fingertips at that point. We've had that problem a few times since as well. And in fifth position, we had How Energy Cartels Will Smash the Housing Market. That was from June 2022, and that was an important conversation with David Llewellyn-Smith. David, of course, is the chief strategist at Nucleus Wealth and the founding publisher and editor of Macro Business. And he argued that Australia was facing an energy crisis, which has been deliberately set up by a cartel of producers across gas and coal. So as a result, we face crippling energy costs and a flow-on through into higher inflation. As a result, the RBA will likely lift the cash rate higher, forcing households and businesses to the wall. But of course, he argued there was a simple solution, one which would slacken inflation, restore normality to the energy market and take pressure off households and businesses. So the question was, will the new government grasp the opportunity, or will they be too timid or even corrupt to do so? And of course, we saw later in the year where they did something, but probably not enough and belatedly. So unfortunately, high energy prices are now wired in, which is going to put more pressure on households and more pressure on the RBA. In fourth position was a show called Australian Housing is Broken from July the 17th, 2022. And there we looked at the proportion of Australians who own their own house outright has halved over 2 decades for most age groups, while the proportion of people with mortgages in retirement has tripled. And that was based on data from the Australian Bureau of Statistics showing that outright home ownership has more than halved for 25 to 54-year-olds between 2001 and 2021. At the same time, the number of mortgage holders and renters across all age groups has ballooned. And the number of Australians who own their homes outright has plummeted over the last 20 years. And the proportion of Australians who completely own their property has fallen by 11 percentage points, according to the latest census data. And according to the recent census data, which counted more than 25 million Australians, the proportion of Australians who own a home outright dropped from 41.6% in 1996 to 31% in 2021. The same data also noticed that over the past 25 years, the number of Australians who owned a home with a mortgage doubled, rising by 96.8%. So this data underscores that over the last 2 decades, property strategies have failed miserably. As of course is because they're predominantly political rather than economic, as I discussed recently. In third position, there was a show called The Property Crash is just getting started from July the 15th, 2022. And there we discussed the Reserve Bank's double rate hike because, of course, big banks lifted their variable mortgage rates by 0.5 percentage points, and that increased the average variable borrower rate. And, of course, since then, it has continued with more people paying more for those mortgages. A lot, of course, were under refinance, but nevertheless putting a lot of pressure on households. And as we discussed, it does take weeks for the monthly repayments to rise past the RBA announcement. So even in July, the increase in monthly repayments were still those relating to the May hike. This is because banks typically give 20 to 32 days notice before lifting their monthly repayments, despite charging their customers the higher rate from the effective date. And even then, the increase to their monthly repayments may not take effect for another few weeks, depending on when they are due. In fact, UBS predicted interest rates could peak at around 3.5% in March 2023, but then said this will hit the housing market hard. We still think market pricing of around 3.5% if delivered would likely crash housing and see the economy nearing a recession, the chief economist at UBS told The Australian back then. If interest rates were to rise to 3.5%, it would likely see the average variable mortgage rate hit a whopping 6% and could plunge the economy into recession, according to the investment bank. Interest payments across the economy next year for the household sector will be close to double from now, they said. And so it's proving to be. And they warned, we have never seen such a sharp increase in repayments that really crushes household cash flow next year when you have cost of living issues. And then in second place, we had a show called And Now the Pain Begins from June the 9th, 2022. And we looked at the latest data as interest rates passed through to borrowers and, of course, the impact on housing affordability and the horrendous mess the RBA has made, which begs the question, of course, where from here? Still a very valid question today. But the post that got the most views this last year was from the 27th of August 2022, and it was called Prepare for a September Crash. And in that show, we looked at Fed Chair Jerome Powell's speech at Jackson Hole, which was just 9 minutes in length, but enough to move the markets down significantly. For the Fed's monetary policy to have any effect, markets must transmit them via the financial conditions to the actual economy, he said. And the Fed needs to make sure this happens. And in a way, that speech was an effort by Powell to get the job done. The speech was one of the strongest ever by the Fed chief, reflecting the onerous burden borne by the central bank in curbing inflation and retreating ever more slowly from 4-decade highs. First, Powell said inflation needed to be controlled. That was actually their main mandate. Next, he signalled there would be more rate hikes in the months ahead, taking the cash rate well above the neutral rate, meaning that they intend to deliberately slow the economy. And he acknowledged this will hurt households and businesses, and acknowledged that the current labour market was out of whack. So in a way, that message cut directly across the ranks who were saying that the Fed will pivot, and argued the Fed was really signalling that it would soon pause the rate hikes or pivot to rate cuts, even though the Fed has raised its policy rates just then 4 times, including twice by 75 basis points, the biggest rate hikes in years. And they went on to do that and will do more in 2023. So once again, the truth is, of course, that rates will be higher for longer. The recession risk in the US is extreme now, and most people are expecting earnings to get crushed next year. So that's what happened last year, and thank you for all those who supported us and watched the shows and shared them and liked them. Really appreciate all of that. With regard to this year, well, I will continue to make daily shows. We made nearly 1,000 last year, and I certainly plan to release shows every day this year. But I'm also going to be focusing on a few specific issues. One, of course, is the question of branch closures, and I'll be continuing to work with the regional and other players in terms of lobbying for change there. I'll be continuing to advocate for changes to the asbestos laws because they're too weak, as I've discussed previously, and continues to work with the Asbestos Awareness Charity. And I'll also be working, as I did last year, with John Adams on the In the Interest of the People channel, and specifically questioning the role of ASIC, APRA, and the RBA, because I have to conclude, looking at what happened last year, that our regulators have let us down badly. The RBA failed miserably in its mandate, and its forecasts for this year are still significantly off. So I think 2023 is going to be a troubled year, but of course I will endeavour to bring news to you on a timely and regular and hopefully unbiased basis. So keep watching and keep supporting what we do. And finally, a thank you to all those who made contributions to us, either as a contributor on the channel or indeed through the Patreon program, or indeed other donations that we received through the year. Every donation is greatly received and helps us continue to keep the channel alive and invest in its future. So I wish you the best for 2023, and we'll continue to tell the story of both the global and the Australian economy and what it means for you. This is Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.